All right, let's get right into it. Today, we're following a really fascinating trading journey. It's the story of how one trader took some pretty painful losses and flipped them into a super resilient new strategy. And she did it by embracing the one thing most traders are taught to fear. We're going to see how a moment that should have been pure panic actually became the key to unlocking consistent profits.
And this quote, man, it just perfectly captures the classic problem with credit spreads, doesn't it? It's such a mental game. You can be winning, stacking up all those small premiums, feeling great, and then bam, one bad trade comes along and completely wipes out months of your hard work. It's a feeling a lot of us know all too well.
Now, this slide right here really tells the story in numbers. Take a look at 2021. A solid start, over $2,000 in the green. But then, look at 2022. That one number in the middle, a loss of almost $10,000 just from credit spreads. It completely vaporized the previous year's gains and then dug a huge hole. That is the one step forward, two steps back feeling in black and white.
But then, something happened. Something that started out as a moment of pure panic, but ended up being a total game changer. This is where our trader's journey takes this really interesting twist, and it's all because of something that options traders are usually taught to dread: early assignment.
So let's look at the first real-world example of how this all went down. It involved a trade on SPY, that's the S&P 500 ETF, and it was supposed to be just a totally standard run-of-the-mill put credit spread.
Okay, so here's the play-by-play. She opened a put credit spread about a month out from expiry and collected a pretty small $85 premium. The hope was, a small win or a small manageable loss. But then, 2 weeks before it was set to expire, the short put got assigned. Now, this is usually the moment your stomach drops. But here's the twist. Because that short put was gone, she was totally free to sell the long put on its own. And look at that result. She sold it for a profit of over $5,000. I mean, what? This was a complete game changer.
So, when you actually do the math and add that little $85 premium to the huge profit from selling the long put, the total profit on what should have been a losing trade was more than $5,000. This was a massive light bulb moment.
Now, you might be thinking, okay, that's just a lucky break, a one-time fluke, right? But then, it happened again. And this time, it was with a trade on Tesla. Suddenly, a pattern was starting to take shape.
And this Tesla trade was even more wild. The starting premium was bigger, almost $500. And when the short put was assigned early on this one, the long put was sold for a jaw-dropping profit of over $9,500. It was becoming pretty clear that the first time wasn't just a fluke.
And this just brilliantly shows you the potential here. The total profit from this single failed trade was over $10,000. At this point, it wasn't just a surprise anymore. It was starting to look like a repeatable opportunity.
And that, of course, led our trader to ask the single most important question in this whole story. Instead of running from early assignment, what if she could build a strategy around it? Could this happy accident be turned into an intentional, strategic advantage? Asking this question, well, it changed everything.
But before she could perfect that new strategy, the market, as it often does, had one more brutal lesson to teach. And this is a really important cautionary tale about a mistake a lot of traders make. It's about a huge misunderstanding of risk and buying power. So the trade was on Meta, and it seems so small, so manageable, just 2 put credit spreads. The capital required up front was only $1,000, and she collected a really nice premium of over $700. On paper, it looked like a totally safe, low-risk position. But that was a dangerous illusion.
Because when both of those legs got assigned early, the actual cash required to settle the trade wasn't the $1,000 she'd set aside. It was $25,000. Suddenly, she was on the hook to buy 200 shares of Meta at $125 a pop, and she just did not have that kind of cash sitting around.
And this slide, right here, this is really the core lesson of this entire story. On the left, you see the painful reality. Because she was using leverage, she didn't have the funds. Her broker had to step in and liquidate everything, and it led to a massive financial loss. But just look at the what if on the right. If she had been cash secured, meaning she actually had the $25,000 ready to go, she would have just bought the 200 shares. She would have kept the premium and been the owner of a great stock. It's the razor-thin line between total disaster and a planned opportunity. So that incredibly stressful wake-up call was actually the final piece of the puzzle. It was time to put it all together.
the lesson about unexpected profits from early assignment, and the very hard lesson about needing to be cash secured. And all of that led to the birth of a brand new strategy.
And here it is, a clear 5-step plan that's really designed for resilience. See, it's not just about finding trades anymore, it's about building an entire system where even the so-called worst-case scenario, getting assigned the stock, is actually a planned and totally acceptable outcome. This is about creating a strategy that lets you actually sleep at night.
Okay, this first rule is maybe the most important mindset shift of all. You stop trading stocks you don't mind owning, and you only trade stocks you would be happy, even excited, to own at your short strike price. This means you got to do your homework. You're looking for financially solid, fairly valued companies. It completely changes how you approach the game.
Next up, even though you're perfectly willing to own the stock, you still want to play the odds in your favor. The goal is to aim for a high probability of profit, or POP, somewhere around 75%. This just makes sure that most of the time you're going to simply collect that premium and walk away. But you're always prepared for that other 25% of the time when you might get assigned.
And this is a fantastic rule of thumb for making sure your risk and reward are balanced. You want to try and get a premium that's about 20% of the width of your spread. So, for example, if you have a $10 wide spread, you'd be looking to collect around $2 in premium. It's a simple check to make sure the potential reward is actually worth the risk you're putting on.
Now, a strategy isn't really a strategy unless you have a clear plan for what comes next, right? So the final, critical piece of this whole approach is having predefined exit plans for every possible scenario. This is so crucial for taking all the emotion out of your decision-making.
I mean, just look at how thorough this is. There's a plan if the price goes up in your favor, a plan if it just sits there, a plan for if the price starts to challenge your position, and most importantly, a clear, calm, pre-decided plan for what to do if you get assigned. This is what trading with real confidence looks like. You've already thought through every outcome before you even hit the buy button.
And this quote from the trader herself really just brings it all home, doesn't it? The money she lost, that was like tuition she paid for an absolutely priceless education. The real lasting profit wasn't just the cash she made from those surprising trades. It was the knowledge and the bulletproof strategy she built from all that experience.
So, we'll end with this one question for you to think about. Take a look at your own approach, whether it's in trading or really anything in life. Is it designed to be perfect all the time? Or is it built with the wisdom to not only survive its own mistakes, but to maybe, just maybe, even profit from them? It's a really powerful idea to sit with.